Okay, good evening to everyone. Well, I'm very excited. It's another Let's Talk Property. I want to share with you some of the fascinating insights that I got from Clem Sunter. I've been to a number of his presentations. I went to one of his breakfasts literally about 10 days ago. And I thought that it would be a really good insight to be able to share with you so that you could understand it. Because I think at the moment, most people are stuck in a situation where they don't like what my Lem is saying. They're concerned what's going on in the global economy. And so what it basically happens is that we get ourselves into an analysis paralysis type situation. There's definitely a lot of uncertainty out there. And so what I wanted to do with you was to share some facts and figures, to share some information with you. And I thought that by doing that, it'll help you make better educated decisions about your future. So today, really, I'm going to look at some of the latest techniques. And Clem Sunter is literally a world leader on scenario planning. And I'm going to look at some of the techniques he uses to look at where the future is going to be for South Africa, America, the UK, and Australia, and then also for the global economy as a whole. You know, at the end of the day, we get asked all the time, you know, where am I investing, what's happening, what do I think is happening between those different countries? And I thought, well, what a better way to share it with everyone in terms of the different scenarios, what's happening, and the research. So without further ado, I want to crack on. I can see that there's some questions already coming through. Kaylee, thank you very much for your question. I will answer your question later on. If anyone else has got questions, please fire them through, and I will try and answer them during the presentation if it's pertinent, or I will leave them to the end. There's going to be a lot of information this evening. If you want to put up your hand, ask a question, just go for it. The more interactive it is, the better it'll be for everyone else. So I want to welcome you all on this evening. Let's get started. We're going to have lots of fun this evening. It's going to be a fast-paced, fast action. But the one thing I do have to ask you is please be attentive. If you sit there trying to play on your Facebook, if you're trying to play on Twitter, send your emails, etc., you're not going to get the essence of what I'm trying to show you here. And this information is very, very valuable to you in terms of making your own decisions in your life. So let's crack on. Let's look at the very first slide, and that is of Clem Sunter. Who is Clem Sunter? Clem Sunter was born in Suffolk, England in 1944. He then went to Oxford University, where he read politics, philosophy, and economics. In 1971, he moved to Lusaka in Zambia to work for Anglo-American Corporation in Central Africa. He then joined he moved on to Johannesburg and became the chairman and CEO of the Gold and Uranium Division from 1990 to 1996. And that was at the time when they were the biggest gold producer in the world. He was, until recently, the chairman of Anglo-American Chairman's Fund, which in a recent survey was rated the premier corporate social responsibility fund in South Africa. In the early 90s, 80s, he established a scenario planning function in Anglo with teams in London and Johannesburg. Two members were Pierre Wack and Ted Newland, who previously headed up the scenario planning department at Royal Dutch Shell and then acted as consultants to Anglo. And this was really where he developed his whole scenario planning technique. He became very famous in the 1990s for talking about South Africa and the high road versus the low road. Oh, I can see there's a lot of people saying no slide. Sorry, guys. There we are. You've got the slide coming up now. And I think the most important thing was that in the 90s, he really developed his reputation in South Africa, where he had the high road and the low road speech. It was whether South Africa takes the high road or whether they take the low road. And as you all know, we took the high road of embarking on talks versus descending into civil war. He was recently awarded the honorary doctorate by the University of Cape Town for his work in the field of scenario planning. He was also voted by leading South African CEOs as the speaker who has made the most significant contribution to and impact on best practice and business in South Africa. In 2006, he was invited to give a scenario presentation at the Central Party School in Beijing, a rare privilege for a foreigner. And interesting enough, the very first foreigner to ever present there, and certainly the first South African. And he's also facilitated sessions on global warming in New Delhi and London. So I think we can safely say that this man has plenty of experience and his reputation precedes him. And I think if nothing else, I spent 700 Rand to be at a breakfast, and there were at least 1,000 people at that breakfast here in Cape Town. So I think that should just give you the type of understanding of the credentials of this man and how what he says and what he teaches us is so important. So I'm just checking the things here. Yeah. Okay, so you guys can see the slides now in terms of where we are. Right, let's crack on in terms of where this is. So where the scenario planning comes from, there was actually a Greek poet called Arkindle. And Arkindle basically came up with many, many years, even centuries ago, came up with the whole analogy of foxes versus hedgehogs. Now, a fox is someone that has multiple ideas. It's constantly coming up with new things. It's very adept to change, and as it changes, the environment changes, it finds new solutions. Then you've got the hedgehog. The hedgehog has one single idea. It has one concept, it has one vision, and it's going to implement it no matter what. It's not that good at adapting to change. And what Clem said is that it's vital in all businesses to have both foxes and hedgehogs. But let's look at what you need to do. And if you look back there, his first book is called The Mind of the Fox. And it talks about the difference between a fox and a hedgehog and how it's very important to have a big vision as a company leader or as a business owner or as an entrepreneur to go out and achieve great things. But in the world of such uncertainty and such change now, he goes on to say that being a fox is paramount, or certainly have foxy people around you so that you can adapt to change on an ongoing basis. He showed and spoke of the very first time that he came across this whole flags analogy, and it was actually back in 1988. He was having a beer with a friend of his. They were doing a scenario planning in England, and he said that it's always good for scenario planners to do it over a few beers. They come up with better concepts. And this guy in early 1988 said, listen, Japan is on the brink of a recession. Now at the time, Japan had been on a growth spurt right through the 60s and 70s and was really sort of starting to grow quite exponentially in the 80s. And they said, well, what are you talking about? I mean, the press isn't talking about this. The economists are not talking about it. They said, how do you know? What are the flags? And the guy said, the fact that golf membership in Tokyo is going down. And Clem said, well, explain this to me. And he said, well, look, the bottom line is the Japanese are completely passionate about golf. And if they are stopping their memberships, it's because something underlying is happening in the economy and they can't afford to play golf anymore. And needless to say, in that year of 1988, the Japanese economy literally imploded. And as we well know, for the last 20 years, it's barely recovered. From there, they had a property boom and bust. They had a stock market boom and bust. And literally, their economy has bumped along the bottom in a very much U-shaped, even an L-shaped, because it basically hasn't recovered. So I think it's fascinating, and this was the first time that he became aware of it. I've heard him speak a couple of times, Clem Sunter, and he talks about these flags. The best analogy that I can give you is that when you're swimming in the sea and you're on the beach, if you see the normal flag that's up that allows you to swim, it means the lifesavers are there and it means that you can go swimming. If there's a red flag, then it means there's some danger. You need to be aware there might be currents or something. And if there's a black flag, and for those of you who go to the beach often and particularly surfers, you'll know exactly what I mean. That means there's a shark warning. So you either got to get out the water and you've got to get out the water very, very quickly. So I like the analogy of the flags because at the end of the day, we're all swimming in the ocean. There is danger, there's uncertainty, there's currents, and things are adapting and changing all the time. But we've got to watch the flags and we've got to change our tactics, change our strategy, change our game plan, depending on those flags. So, with that introduction, let's get into the scenarios that Clem speaks about for the global economy. The first one is hard times. Now, this is where the economic growth globally is going to be flat, it's going to be ugly, and there's going to be low growth for 5 years. Basically, the problem here is that the problem that caused the financial crash has not gone away. It's just changed. The debt started out with the banks, and now it's actually moved on to the governments. I mean, in Germany, it's basically Germany is bailing out Greece, and that contagion debt is now moving on to Italy and to Spain. Greece has 200 to 300 billion euros worth of debt. Italy, on the other hand, has 1 trillion euros worth of debt, and a lot of that has been passed on to America. Between 8 to 10 billion of that is held just by Citibank. And then you've got Spain. Now, in Europe, the recommended debt to GDP ratio is 60%. The UK is currently sitting at 80% debt to GDP ratio. And America, interestingly enough, has just toppled 100% debt to GDP ratio. Now, the last time that America was as high as this with regards to debt was in 1943, which was right in the middle of the Second World War. And they did it to expand and build their military for the Second World War. The problem is that the only way that they got out of that debt and got it back down to about 40% of debt to GDP was with huge growth in the 1950s and the 1960s. Now, my question to you is, do you think that there's going to be that type of growth over the next 20 years? And then what about Greece? Greece's debt to GDP ratio is 140%. So let's look at just some illustrations of this debt problem, because I got this website recently, a couple of days ago on Facebook, and I thought this was so valuable, and I thought this would be invaluable for you guys to see. So here you've got a $100 note. Okay, it's the most counterfeited money in the world and keeps the world moving. Here you've got $10,000 stacked upon each other. So this is enough for a great car, or to buy a great vacation, or to buy a used car. Approximately 1 year of work for the average human on earth, $10,000. Okay, now you've got $1 million. It's not as big a pile as you thought. Still, 92 years worth of work for the average human. And you can see the website there if you want to go and check it out, WTFnoway.com. $100 million. Plenty to go around for everyone. Fits nicely into a military-sized pallet. And you can see there the reference to the human being, just so that you've got an idea of the size. What about 1 billion? Now you can see 1 billion there on the pallets, and also in reference to that human being there. And you can see that if you were robbing a bank, that would take quite a bit of energy and quite a bit of trucks. Now, let's look at 1 trillion. When the government speaks about 1.7 trillion deficit, this is the volumes of cash the US government borrowed in 2010 to run itself. Keep in mind, if you double stacked pallets of $100 million each, full of $100 bills, you're going to need a lot of trucks to freight this around. If you spend 1 million a day since Jesus was born, you would not have spent 1 trillion by now. But 700 billion is the amount that the banks got bailed out, just to put it in perspective. Let's look at that same picture. On the left, you've got an American football field. On the right, you've got a soccer pitch, and you've got a Boeing. There you've got the truck, and here you've got the money. So just to give you an idea of the size and the magnitude of this debt. And then lastly, the $15 trillion. So unless the US government fixes the budget, the new US national debt credit card bill will topple 15 trillion by Christmas 2011. The Statue of Liberty seems rather worried as the United States national debt passes 20% of the entire world's combined GDP. In 2011, the national debt will exceed 100% of GDP and venture into the 100% plus debt to GDP ratio that the European pigs have. So basically the bankrupt nations, which I've already spoken about in terms of Greece, Italy, Spain, Ireland, etc. But there's one last thing that I think is very important here. And this is this slide. Here you can see the Empire State Building. There you've got the Twin Towers that got blown up by the planes. Here you've got the Statue of Liberty. There you've got that football field with that plane. And on the right-hand side here is the stack of debt that the country actually has in America. Let me read you this look at. $114 trillion debt, US-funded liabilities. To the right, you can see the pillar of the cold, hard $100 that dwarfs the World Trade Center and the Empire State Building, both one of the tallest buildings. If you look carefully, you can see the Statue of Liberty. The $114 trillion super skyscraper is the amount of money the US government knows it does not have to fully fund the Medicare prescription drug program, Social Security, military, and civil servants' pensions. It is the money America knows it will not have to pay all the bills. If you live in America, this is also your personal credit card bill. You're responsible along with everyone else to pay this back. The U.S. citizens of America created the U.S. government to serve them. This is what the U.S. government has done while serving the people. The unfunded liability is calculated on current tax and funding inputs and future demographic shifts in U.S. population. So you can now just see the size of the debt problem which is on the horizon within America. So that really is scenario one with the hard times. There's a second part to scenario one, and that is that in the first world countries, demographically, they are aging. So what you've basically got in somewhere like Europe, and particularly in a place like Italy, is that you've actually got a declining population, and there's actually a geriatric boom. If you want to make money, learn how to make and sell walking sticks. But I mean, it's very interesting. The average age in America is 49. This year is the last year that the baby boomers will actually hit 50 in America. The average age by 2016 of the average baby boomer will be 70. 70% of the American economy is driven by consumerism, and 75% of that consumerism is actually driven by the baby boomers. However, they are getting older, and when people get older, two things happen. Firstly, they literally start saving for their retirement, and secondly, what happens when everyone gets to retirement and all their money is tied up in the stock market? How do they get their money out? There's only one way. They sell. So what do you think is going to happen to the stock market? Now, interestingly enough, what do you think the average age is in China? It's 47. So these aging populations in England, in Europe, in America, they've got major problems for supply and demand in terms of what's happening with the population growth. So the big thing with the hard time scenario is that Clem thinks that it's going to be a corrugated U. There's going to be lots of ups and downs. It's literally going to bump along the bottom for at least 5 years and literally continue. And this is the one that is their favorite scenario. This is the one that they believe is most likely going to happen. The second scenario is the ultraviolet scenario. Now, in the ultraviolet scenario, this is where the advanced economies go into a U, and they're going to get an average of 2% growth per year. The emerging economies are going to get 3 times more growth, with roughly a 6% GDP growth. He said the places to focus on were China, India, Africa, South America, and very interesting enough, Australia was the only first world country which actually came up. He said the one critical flag to watch here with the ultraviolet was China's growth. Because if China could continue to grow at 8 to 10%, it would pull everyone else along. However, if it stumbles to around 5% GDP growth, then it's going to pull everyone else down. He went on to say that he's less optimistic about China. He said the Japanese earthquake has caused a major problem in the Japanese economy, and they're China's major trading partner. The second thing that is very, very concerning is the number of unoccupied properties in Tier 2 cities. And this has all been built with municipal debt. These properties are standing empty and is really starting to smack of a property bubble because of supply being out of kilter with demand. Inflation is rising in China, and they have to try and curb that. And also, the fact that it's now a $6 trillion economy, it's very hard to continue to get such huge growth off a high base. You know, when it was a low base economy, it was easy to get that huge growth. But off a high base, it's very hard to continue to get that growth. And he said that, you know, just like happened with Japan, Japan started out as a cheap replicator. They used to literally copy American products, replicate them, and sell them. But then they became an innovator. And China now is a cheap replicator, but it needs to start becoming an innovator. And something that I found also very, very interesting was a separate article that I read on China. And something that's very concerning is a lot of what the Chinese output, 40% of the entire Chinese economy is based on the American economy. Now, when you consider that I've just told you that 70% of the economy is based on consumerism, and that 75% of that consumerism is coming from the baby boomers, who are starting to move into old age and retirement, it's a very concerning stat when you think that 40% of the Chinese economy is based on that American economy, and that the Chinese cannot afford the produce that they are making. Now, there's a counter-argument here, if you read from an economics point of view, that they've got a big emerging middle class and that they will be absorbing that. But it's just interesting. As a scenario planner, you've got to be able to and as a fox, you've got to be able to understand both sides of the table. So interestingly enough, Clem gives a 40% probability to the hard times and a 30% probability to this ultraviolet. The third one is what they call new balls, please. And he said, just like in tennis, when the recovery comes, they're going to need a complete change. He went on to say that this is going to be a multipolar economy where East is as big as the West. The West has basically dominated for the last 600 years. And now what the problem is that we're actually running out of resources. Thomas Malta in the 1700s said that the population was going to literally expand so much that it was going to lead to starvation. Now, we're already starting to realize this with huge problems with food and water and with energy. We've only got enough cheap oil for another 100 years. And what is going to change this is that prices are going to force change. The next round of technology growth is actually going to come from resource efficiency. There's two flags to look with regards to this scenario. The first one is American unemployment needs to remain below 7%. If currently American unemployment is actually around 9%, and funny enough, it's recently gone from 9.1% to 9.3%, so it's actually going in the wrong direction. And the second flag that you need to be looking at is a drop in debt ratios. And then the last scenario that he talks about is what they call forked lightning. Now he gives a 10% probability to this, and this is where we embark on the double dip that everyone's been so worried about. When the stock market dropped in 1929, it crashed, but the real crash actually came in 1932. By 1932, the stock market was only 11% of the value of where it was in 1929. The average American lost 80% of their money in the stock market. Now, the question is, what are the flags for this forked lightning? And Clem's done a number of research with a lot of hedge managers around the world. And the number one flag is the 10-year US bond rate. If it jumps to around 5%, it's currently at 2.9%, then there's going to be a major problem. At the moment, and it has been for many years, the US Treasury is the safe haven. The government is paralyzed, with regards to the economy. And if QE2 has come to an end, which it has, in terms of the debt, literally US Treasuries are the last exit. But what will happen if they can no longer lend? What will happen if the commercial banks can't rely on the central banks? Because at the moment it moved from the commercial banks to the central banks. But if the bond rate rises, then it will basically mean that people don't have confidence in the American central bank anymore, and there will be no safe haven. And if that happens, then if that bond rate starts to go up, you have to sell your stocks. You have to buy properties and you have to buy gold, because it's going to be a very tough world. And this is going to be the hardest of all the scenarios. So you can see there's 4 different scenarios. Now let's look. I want to play you one last thing. Now this isn't from Clem Sunter. This is from a guy called David Houle. Now I was at David Houle. He's actually a futurist. I was at a presentation by him about 3 or 4 weeks ago at the SAPOA, which is the South African Property Owners Association. And David had some very interesting things to say about Africa. And I wanted to play this for you because I think it's essential for you to understand what his thoughts were. And it really opened up my ears and eyes as to what might be possible. So let me just open this up for you quickly.
Now, this is a phrase that I've been saying since 2007 in Canada and the United States. And when I say data, here's the content that they're not intended. As low-cost producers increase their success as being low-cost producers, they price themselves out of the marketplace. For Alger Boy, the cheap stuff in the States made in Japan. That was in Mexico. That was made in China. The suits, nice suits, were made in Vietnam. So by 2020, what's left? The impoverished, vulnerable countries of Africa. This is going to be the golden age in Africa, 2020 to 2035. Absolutely. Absolutely, without question. That's why the charities are coming in. That's why there's so much focus on this continent. If you are going to be in the real estate business for the next 5 or 10 years, you're going to see a gold rush, or whatever the metaphor is, you've never seen before. So future timeline, look. So the good news is you can stand up well against those. It doesn't matter how big you are. Okay, so I heard yesterday, it's like 1% of the GDP of the world comes from South Africa. Is that right? What? How much? Half of 1%. Okay. So half of 1%. So that means that China, which is 27 times bigger in population than you, would have to have roughly 14% of the GDP, and they don't have it yet, right? So relative to that, you're pretty powerful. So it doesn't matter that you're a BRIC country or the lights for water, continented countries. I've said this conversation here about, well, we're part of Africa, or we're part of the first world, how do we do this, or, where we position ourselves. Position yourself as the leader of Africa. We're going to talk about where we're going here in just a second, but between now and 2015, why not decide that you're going to be the leader of Africa? Certainly, sub-Saharan Africa, there is not a financial center in this. This is the second largest continent in the world, population-wise. There's not a major financial center. You've got one of the number one. You've got trillions of dollars of stuff underground here. But it doesn't have to be in South Africa. Africa's in your name. Now look at that. Like, it doesn't have to do with whether it's this continent or not. You can go to South America, right? You've got Brazil. You've got Peru. You've got Colombia doing really well. You've got Ecuador not so well. So it's not like we all got to do well. The sub-Saharan Africa growth rates, as we heard yesterday, I think you're going to hear today, are better than any place else in the world. Embrace it and live it, and I'll show you why. But the point is, there's always got to be countries that lead continents. South Africa should lead this continent.
Okay, guys, I got lots of comments there about the quality, and I do apologize. It comes through quite clearly on my side, but obviously not coming through very clearly on the webinar. Now, I will email you all that clip, so all of you that have asked, thank you very much. I do apologize, and I will email it through to you. But let me just, Slaven summed it up. Let me just quickly repeat what he said, because I think it's critical. Firstly, like I've already mentioned, China needs to move from being a replicator to an innovator. And so there's going to be nowhere left with cheap labor except for Africa. And he said that in the way that both charities and business are coming into Africa, because there's massive resources, there's $1 trillion worth of resources underground here. It's also the second biggest population worldwide in the world, so in terms of where Africa is. And he said it's going to be the biggest gold rush in Africa from 2020 to 2035. And I think that, for me, is absolutely critical. So and there's, you've got his picture and you've got his details. But the critical thing that he said is that we here in South Africa, we have to lead the continent. We've joined BRICS. We've got to get on top of our policies. We've got to get on top of the bureaucracy. We've got to get on top of whether people are being bribed. I mean, I'm quite happy. If you want me to, I can send you the full talk, because it was about a 50-minute talk, and he was very positive about South Africa. And if you know this, there was research done by Accenture, and if an international company comes in to Africa, they've got an 80% better chance of being successful if they come in via South Africa. So Africa is the future, and we are at the foot of Africa, and we have the expertise to help companies go into Africa. I mean, it's no coincidence that Walmart is coming into Africa and they're buying Massmart, and they're using that as their stepping stone to get into Africa. I got another article which I can send you as well in terms of the foreign direct investments and how Africa is now the #2 place that people are looking with regards to foreign direct investments. And they predict, Ernst & Young, over 350 million jobs over the next 10 to 15 years in Africa through this foreign direct investment. So I think you can see the importance that is actually taking place here and the importance that Africa has. Now, let me move on to the next slide. And this is where I wanted to share with you my probability calculator. Now, this basically is, for me, I put this all together, and I just want to close it all up for you here quickly, and then I'll take you through it. So this for me is really, I sat in that presentation and I thought to myself, well, what is it that all these probabilities mean to me? Because I'm a fairly mathematical person. So I wanted to try and see, well, if I've got this sort of mathematical approach, and if basically Clem Sunter gave 40% to hard times, 30% to ultraviolet, 20% to new balls, please, and 10% to fork lightning. Now, just very quickly, let's run a quick poll. Who thinks that these global scenarios are right? So if you could please start to fill them in, you'll see them coming up on your screen. Okay, I can see that most people have voted there, and pretty interesting. Let's close off that poll then. So you'll see the results come up now, and very interestingly enough, 55% of people said yes, 6% said no, and 35% said don't know. So you can see it there coming up on your screen. So it's just interesting in terms of where people are. Again, there's quite a bit of split debate. They do a tremendous amount of research in terms of looking at this. But now look at what I did in terms of a spreadsheet here to try and see the different scenarios. So the first thing that I did was, if you open this up, I basically put in 4 different countries, and I wanted to look at 4 different ways to invest. So I said, well, if it's hard times, I then ranked them between 1 and 4. So I said that if it's hard times, South Africa would rank at number 2. And the reason being is that we managed the global financial crisis well. The banks are in a strong position. We've got a growing population. We've got resources, although politics is not making us very popular at the moment. So I'm not sure if you're aware, but we're not very good. Okay, sorry, let me just close the poll. We're not very good at the moment in terms of the resources because of what is actually happening. And because of the whole, is it going to be nationalized, and the whole Malema talking, etc., etc. Number 3 for me was America. It's 100% debt to GDP ratio. There's more growth potential, and it's got a growing population. Number 4 was England. This is reason is because it's got a huge debt, 80% debt to GDP ratio, but it's also aligned to Europe, which has major structural problems and an aging population. And then number 1 was Australia. It has no debt and has navigated the global financial crisis the best so far in all the G20 countries. The banks are strong. It's got a growing population, and it's close to China, and it's also got resources. So I gave them a ranking of, as you can see there. In the ultraviolet, I actually gave South Africa a number 1, and this is because we're an emerging economy and will be the future, and South Africa is the gateway to Africa. 80% chance of being more successful if you come through a South African company, but as I said, it all depends on China. Okay, then the America I put number 3, England number 4, and then Australia I put, Australia is the only first world country which is included with the emerging economies, but it won't have as much growth as the emerging economies as it's got a higher base. It has resources and is well located to China. Then, with regards to the new balls, please, and I can see I've got a spelling mistake there, but I've said that South Africa will come number 1, and the reason for this is that it's got resources and it's also on Africa's doorstep. The next focus point, the golden age of Africa from 2020 to 2035, huge potential. And the other thing that I said is that with the running out of water and food and resources and energy, Africa has that. And South Africa and Southern Africa is one of the breadbaskets of the world, and so we'll be able to continue to supply food. Third, I put America, got resources, but they don't have enough for their own country, and labor is too expensive. England, I put, doesn't have any resources, so I put them in at 4th. And Australia at number 2. They are resource heavy and also have a sophisticated economy close to the east, and is number 2 due to the problems with water. So the biggest problem in Australia is the lack of water for that huge island. And then the last one, Fork Lightening, I actually had South Africa at number 2, and that was because we've got resources and Africa on our doorstep. So even if the world economy was to go into a tailspin, I believe that that would act in our favor. The America I put at number 4 because of the huge debts. They're the global standard, and if they can't print money, there'll be serious problems. There will be a revolution in their country over the debt. In number 3, I put England, not as heavily indebted as America, and don't have the pound as the global currency. And number 1, I put Australia. It's the strongest G20 country through the GFC, got good regulatory environment, educated population who pays tax, which for me is very, very important. And Anita says here that dream on about South Africa. You think the national demographic revolution will go away. you spend too much time out of the country. Interesting you say that, Anita. I live in South Africa and have lived here for the last 3.5 years, but I will be covering yours because I'm just giving you scenarios on South Africa around the rest of the world. We'll come to South Africa now. So let's look at that and just look at the overall averages. So the interesting thing is, out of 4, taking into account their probabilities, you can actually see that South Africa, and what I've done here is I've taken their ranking and I've multiplied it by the probability. South Africa is actually tied first with Australia, then you've got America third, and you've got the UK fourth. So that just gives you an indication of my sort of feelings and trying to break down with regards to the scenario planning. Now, let's look at some more of where we are. Now, something else that's very interesting is, where do you actually look to invest? Now, you can see here there's a slide that comes up which is property versus other investments. Now, the source here is actually Barclays Capital. And what Barclays Capital did is they took their high net worth individuals and they literally looked at them from the year 2000 to the year 2010. Now, during that time, there was a stock market boom and bust. There was a property market boom and bust. And so what they wanted to analyze was which was the best asset to invest in. And taking the 10-year return, gold was 323%, oil 214%, fine wine 178%, property 109%, etc., 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 and shares was down at minus 14%. Now, the interesting thing for me was that property was also ungeared property at 109%. So geared property would be at 436% if you were working at a 75% loan to value. So let's just take a look here in terms of where we are and what this actually would mean. Now, let's go back to that calculator. Now, as someone that's wanted to take everything that Clem has said, I then wanted to look and say, well, should I be investing in the stock market, in property? Should I be leaving my money in the bank, or should I be looking at gold? And I then went again, and I again did a further scenario, and I just want to close off the summary here quickly. You can see here, I put the stock market at number 2 under hard times, and I said the stock market will perform well, but you have to be very experienced as it's going to be very volatile. I said property, because of a lot of volatility, you can stick to this as a long-term investment. You have to make sure that you buy it at the right price, and also in markets where the fundamentals of supply and demand are in kilter. Money in the banks, I said it's safe, but you will be eroded by inflation and no incomes. Also very low interest rates being paid at the moment. Also worth keeping some money in the bank to take up opportunities. And then finally, gold at number 3. Gold always does well in uncertain times, but it doesn't earn an income. So that's why I gave it a 3 there, because it doesn't earn an income. Under the ultraviolet, I gave the stock market number 1. If you can choose the right companies in the right markets, then you will get great growth as they grow quickly in these emerging markets. I chose property as number 2. I said you need to balance getting a great growth in the emerging markets, but balance the risk in that market by also investing in first world assets and income to offset currency devaluation. Money in the bank, I put at 4. This will not be a good investment with low returns, but it is worth always keeping some money in the bank to look at taking up opportunities. And then lastly, gold at number 3, same as the hard times, although less attractive in a growing economy. And then in the new balls, please, I said the stock market, if you can choose the right companies in the right markets, then you'll get great returns, but you have to be very experienced in resources, efficiency, and technology to make good returns. Number 1, I gave to property, and I said resources, even for housing, will drive prices in a high inflationary environment. Number 4 was money, as with the last review, but always worth keeping money, so same as what I said. And number 3 is this will be a steady eddy investment, but without any income for gold. And then lastly, for the fork lightning, I put the stock market number 4, because the stock market will crash, high inflationary environment, and a global depression. Property, I put at number 1. Property and gold will be the only safe haven as it is inflation proof. Look at what happened in Zimbabwe with regards to property when their whole economy imploded. Property actually remained in US dollar terms. It kept its value in good property in the suburbs and in places like Borodale. It kept its value and actually had really, really good growth. It was the only asset class to actually grow. Then number 3, money in the banks. Problem is that it will devalue with inflation, as high inflationary environment due to the currency devaluation. Always worth keeping some money in the bank to take up opportunities. And then lastly, under fork lightning, I put gold as number 2. This is a constant recession-proof investment, but doesn't earn an income. With the lack of confidence in the financial system, people will go back to the gold standard. And the only reason I gave it to number 2, where I gave property number 1, is that property earns an income. And Bob Max has said, you are property biased. And he said, which countries are these figures taken from? I don't understand the question, Bob, in terms of which countries. The probabilities and everything are from Clem Sunter, and everything else is the research that I've put together. So I just wanted to show you there. And Bob has said that I am property biased. Interesting that you say that, Bob. Everyone's got their own opinions. I basically wanted to put the analysis together and to weigh up what has happened. I've showed you the graphs from Barclays Capital, which is completely neutral, taking the last 10 years and comparing the different asset classes. And then what I also wanted to do was to weigh up the 4 different types of investments and see which one would be better, taking into account the different scenarios, basically. And interesting enough there, property came in first, the stock market came in second, gold came in third, and leaving your money in the bank came in fourth. Okay, Willem has said, property, take into account the new laws that will increase levies on rental properties, rates as per business units. Interesting there, Willem. I'm not sure if you're up to date, but they've already changed the talk on that, and that is only going to be for guest houses, hotels, etc. It's not going to be for basic second-hand properties that are going to be rented out. The Barclays Capital figures, that's for the UK. So it's all Bob Max has asked, where did those figures come from? It's for high net worth individuals based in the UK and their investments in the UK. Okay, so let's look here basically in terms of where we're at. I can see that we've got lots of debate going on, which is awesome. I wanted to give you some interesting stats in terms of where we've basically been looking at. Okay, so let's just look now at some research, and if you're interested again, I can send you through this research. But I think the most important thing, if you look at the American economy, I've explained the problem that you've got in America with regards to the debt, and I think that's the biggest thing that I am certainly aware of. The second thing that I think that you need to be aware of is that what caused the subprime crisis is the reset mortgages. So you can see them here in the purple. Now, basically what happened is that they gave very cheap financing on short fixed-term mortgages with either 2, 3, or 5 years. What happened is that when the guy got to the end of the period, they said, well, how will I do it? And they said, no, it's no worries, just go and refinance. And the problem is that these reset mortgages all started maturing around 2007, 2008. That spike there is actually Lehman Brothers going on under. So that's literally what happened. Now, what's happened with the subprime crisis is you can see that it's tailed off, but actually now it's the securitized commercial debt, which is the commercial property debt, which is starting to come through on these long-term fixes. And they now reckon that over $1 trillion worth of debt is going to start coming into the market in the next in the next year or two. Something else that's interesting is that foreclosures have decreased dramatically by 29% in America over the last 6 months. The problem is, though, is that from June the 30th, 1.2 million U.S. homeowners, nearly 1 in every 111 households, received a foreclosure filing. The problem is that the reason that the foreclosures are decreasing is because the banks are actually getting slower and slower. And there's actually, they reckon there could be between 7 and 10 million homes in shadow inventory, which is actually where the government is holding back, or not the government, sorry, the banks are holding back property because they don't want to bring any more repossessed properties onto the market. And because of that, they're actually delaying the whole process. There was also a huge scandal which happened a couple of months ago where literally some of the people involved, bank employees, were signing foreclosure documents without the proper protocols. That's also caused the banks to delay it even further. So the problem that we see is that there should have been another 1 million foreclosures taking place in 2011 that will now move on to 2012. And as a result, it'll only prolong the housing slump. This casts an ominous shadow over the housing market where the recovery is unlikely to happen until the current and forthcoming inventory of distressed properties can be whittled down to a manageable size. So I think that just gives you an idea of what is happening in America. And I know certainly in America that there's some great opportunities, but one has to be very, very careful basically. And they go on to finish off here. They said instead of the housing returning to somewhat normal conditions by 2014, we're looking at 2015 or even 2016 before we can expect a recovery. And you can see there the graph, which just shows you what happened with American households in terms of the growth, where it actually peaked in April 26. By April 2009 was the first bottom of the double dip, and now basically where they are again. So it's very much been bumping along the bottom. I'll come back to all the comments, Bob. I'm interested in your comments. I was actually living in London for that whole period, basically. Let's move on to the UK market and some of the UK research that has actually come out. The interesting thing with the UK is that property is actually down by 0.8% in June on a month-to-month basis, so that's taking a 12-month average. And the transaction volumes have actually looked to increase. In the current market, a fall of 0.8% is relatively large. One of the reasons that it fell is that there was a flurry in March and April where people were trying to buy properties north of £1 million because there was a stamp duty saving. So there was a huge increase. The big thing that I think is of interest is that in London, the price increase has been around 5% since June 2010 and was greater than any other region year on year. Transactions are growing more slowly than anywhere else in the country. The annual price falls outside of London and the southeast are beginning to increase demand as affordability of property improves. The interesting thing here is that prices rose 79% for the first 5 years to 2006. So they did a 10-year review over the last decade, and then only increased by 11% from 2006 to 2011. This means in the last 5 years, house prices have grown more slowly than inflation, which has risen by 17% since 2006, and also more slowly than salaries, which has increased by 15% in the same period. While the rapid gains in the first part of the decade look unlikely to return in the near future, buyers able to obtain mortgage finance are finding property getting more and more affordable relative to their incomes. Deposits required for first-time buyers still remain the biggest barrier to entry there. And then, just interestingly enough, I wanted to show you some of the graphs. The most important thing for me in England is actually the transaction. So you're borrowing at the moment at 0.5%. I've got a 5-bedroom house in Wimbledon as an example where my mortgage is literally £26 a month. You can be living on the dole and you can still afford to be able to keep that property. The challenge is, so as a seller, I'm not being forced to sell at all. As a buyer, the problem with buyers is that in 2007, there were over 2,000 different ways to borrow money. Today, there's less than 100 ways to borrow money. In 2007, the average borrowing rate was around 5.5%. Today, the average borrowing rate is actually more than that, even though the base rate is less than 0.5%. And so the biggest thing that you've got is actually the difficulty of getting finance. And the last nail in the coffin is that the average loan to value in 2007 was 95%. The average loan to value today is about 80%. And I wanted to read you a stat here, which I found absolutely fascinating. And it said here, by 2025, the average age of first-time buyers will be up to 41, up from 38 today. And the big reason for that is that the average salary in England is £20,000 a year. The average property is £220,000. If you take 20% of that, that's £40,000 plus costs, it's about £50,000. And that's why it's taking them so long to actually be able to afford to buy. Something else that I found very interesting, because for me supply and demand is the most important thing, is that the Office for National Statistics has recently announced that the net migration into the UK rose to 242,000 for the year ending September 2010 and is now the highest level since the year ending June 2005. The big thing with these people is that they're lacking a deposit and don't have a credit history, and so they are going to not necessarily be able to buy property on arrival, but they will put an upward pressure on the housing market with regards to a demand for rental accommodation. In the longer term, however, this positive net migration, increase in birth rates and in family size, and the fact that we are living longer all put a pressure on the housing stock. And there's a huge amount of research here as to what they need to do and what they're going to do. But I think the most important thing, just to show you from this graph, is that the average transactions for the last 20 years has been about 100,000 properties per month. It's literally sitting around 60,000. In the bottom of the dip in March, April 2009, it got as low as 25,000. So they say, yay, transactions have doubled up to 60,000. But you must understand, they're still 40% off the peak of where they were. In terms of growth, the other thing that's very important in England is that you must understand that there's actually 7 different indices. I always use this one, which is the Financial Times Index. It takes all property into account, but you can see the 7 different indices, and the press often like to use whichever one is the most dramatic. But you can see what has happened over the last 12 months. And then lastly, in terms of the different areas and where one should be looking to invest, London continues to outperform anywhere else with the market, and you can see there the growth in London over the last 12 months. And then Australia, well, Australia is a very interesting one. Australia, it was the first and only country in the G20 not to go into recession because of the global financial crisis. They actually they acted very quickly, and in the space of 4 months they dropped their interest rates by literally 66%. They went from 8.5% to 3%, and because of that they brought in a first-time homeowners allowance, and the market literally stabilized very quickly in early 2009 and then grew really dramatically through 2009 through 2010. Australia was the first country to put up interest rates in the G20 because they didn't want to get into inflationary pressures, and because of that, Australia is in a very similar cycle to any other market that I've been involved in, and anyone that's been involved in property will know it, in a rising interest rate cycle, because they've now risen interest rates 8 times by 0.25%. The market slows down and some opportunities tend to arise because developers and sellers sometimes get themselves into a little bit of trouble. So the interesting thing here is that rents are rising in Australia because people aren't able to afford to buy property and because interest rates are rising. But the average fall in property has been roughly 2.7% over the last 12 months. The major reason for this was because of the rising interest rates. The fundamentals of the economy are still very sound, where there's large demand in terms of population growth in comparison with supply, with what they can actually bring to the market. It says here the capital city home values have now fallen for the last 5 consecutive months, with by far the worst seasonally adjusted results coming in the month of January, which accounts for the decline. The softening in Australian home values is delivering a valuation dividend, with Australian dwelling price to disposable income ratios falling to 4.2 times, which is the lowest it's been since June 2003. Tim Lawless said, for property investors, rental yields are also improving, with RP Data's index showing that gross Australian apartment yields have now risen to 5%. The best rental yields can be found in Darwin, Canberra, Brisbane, Sydney, and the worst yields are in Melbourne, Adelaide, and Perth. Interestingly enough, over the 5 years to the end of May, the Australian capital city dwellings are now down by 2.3%. If we look at the last 5 months, the Australian home values have stepped back 2.7%. And then also the thing that I found very interesting is that there's 2 very important components that you need to understand. A lot of the market is driven, and people talk about it sensationally, what's happening in the top end of the market, the most expensive part of the market. You can see this bright red graph here and what actually happened, and when it drops off, everyone said property has dropped by 20%, etc., etc. That's not what it is. You've got the top with regards to the red, you've got the middle in black, and then you've got the green with regards to the most affordable. And you can see how those charts, and as an investment strategy in Australia, we focus on middle income Australia, which is 85% of the population, and you can see the difference there in terms of that versus the top end. So some of the top end properties on the Gold Coast, in Sydney, to the north of Brisbane, on the Sunshine Coast, that is where there are significant discounts because people have got themselves into quite a lot of trouble. And then interestingly enough, here you can see the average dwellings, and you can see that Sydney is the only area that's actually had house price growth. And I think the one thing that I've certainly learned that is so important with Australia is that you can't talk about the Australian market. You've got to focus on 2 things. You've got to focus on the sector of market, like I've just proven over there, and then you've got to focus on the actual city, because it can be literally booming in Sydney and busting in Perth. It can be growing very heavily in Melbourne and going sideways in Brisbane, and one needs to understand all these different facts and figures. But as I said to you, I've got all the research in terms of where you are. I think the final thing here is that Mr. Lawless, the soft market conditions reflect a weak level of consumer confidence across the country. Consumers are well and truly focused on saving, not spending. Despite the low rate of unemployment and the strength of the resources sector, it is clear that the average Australian is content to pay down debt and wait for some economic certainty to return. As a consequence, transaction volumes in the real estate market are 20% below the 5-year average, and listing volumes are 25% higher than they were last year. So I think that gives us a good overview of the Australian market. And then lastly, a beautiful picture that I found here for Cape Town and for me, for South Africa. That, funny enough, ladies and gentlemen, I'm living very near to that, and that's actually the view that I can see out my window when the sun is shining. But I think the interesting thing with regards to the South African housing market is that according to the APSA Housing Index, June 2011 saw moderate nominal year-on-year growth in house values in the middle segment of South African housing market after some price deflation occurred in recent months. The nominal price growth is 1% recorded year-on-year after prices declining for the first 5 months. And interestingly enough, the small houses, so 80 to 140 square meters, has grown nominally by 6%. The medium house prices have grown by 0.2%, and the large house prices have grown by roughly 1%. And I think, just to give you some of the graphs here, which I think are important, you can see there the housing price in South Africa and what is actually happening, both the nominal and the real year-on-year change. You can see here with regards to the different types of properties, so the small, the medium, and the large, in terms of what is performing and which one is doing better. And then lastly, something which I find very, very fascinating is I found this this graph basically which shows us property from 1966 to 2010. You can see the growth in the South African property with it leveling off over the global financial crisis. But I think something which is absolutely fascinating, the average price of property has grown by 11.6% from 1966 to 2010. If you extrapolate it forward at just 10% and in 2050, the interesting thing is that the average price of a property in 2050 will be 46,846,959 rand. Okay, now just to put that in perspective, your home loan on a monthly basis, if you take the current interest rates today, will be 460,000 rand a month. You'll be needing to earn 1.5 million rand a month to be able to buy a property. Very interesting when you take future predictions on what is actually going to happen. So I find that fascinating. Just to repeat, by 2050, if you take the average growth, etc., you're looking at a property being the average house that's covered currently about R1 million, will be 46 million rand, and you'll need to earn 1.5 million rand a month to be able to actually buy that property. And then lastly, another bit of research that I did, I took from 1978, I took the APSA Housing Index and I took the Australian Property Housing Index, and I wanted to show you the impact of investing the exact same amount of money over the last 32 years, taking into account inflation, currency devaluation, etc., including house price growth. And you can see here the red line is the APSA Housing Index, and the blue line is the Australian Housing Index. And the really scary thing is that there's actually a 3.5 times difference. You would literally be 3.5 times wealthier if you invest in Australia over investing in South Africa. So just something to take into account as a South African investor when one's looking at your wealth and your wealth preservation. I'm a big believer that you can get high growth in South Africa, but you need to put some of your money offshore because of this currency devaluation and the impact that it has on your wealth. And I just wanted to show you the long-term graphs. Now, a lot of people say to me, well, what's the difference between the different countries? Let me just give you a quick overview. I put a table together. If you take the economy, Australia, we're having an economic shift to China, and it's in a growth economy. The UK has just come out of recession, and there's big problems with regards to Europe. And America's in a growth phase, but there are structural problems. In terms of the debts in Australia, virtually got no debt. The UK has 910 billion pounds, and America has $14.3 trillion. And I've shown you the slides on that. The GDP growth for 2011, Australia is predicted, and this according to the IMF, at 3.5%, UK 2.5%, and America 2.6%. The average property for the last 50 years, 50 to 100 years, in Australia was 9%. So it's 100 years in Australia. In the UK, it was over 50 years. It was 9%. America, the market's too big. I can't find research on the whole market and the growth that they've had. In 2009, the property in Australia grew by 8.6%. In the UK, it lost 15%, and in America, it lost 40%. In 2010, the Australian market grew by a further 6.1%. The UK grew by 6.5%, and America actually didn't. It just stayed literally stable as to where it was. And then in terms of Australia, the risk is average and the opportunity is average. In the UK, the risk is average and the opportunity is average. and in America, the risk is very high, but the opportunity is great. And I think there's great opportunities in America, but for me, the risk is too high. I can't find people on the ground that I trust. And the research that I've done, and I've spent a month last year in America looking at opportunities, the research that I've done is that the risk, because for me, I'm an income-based investor, and income is my most important component, and I can't see where that's going to come from when there's such a huge dichotomy between supply and demand. Something else I wanted to point out that's very, very interesting, where supply and demand is out of kilter, where there's too much supply, markets like Dubai, Ireland, America, Spain, they have not recovered at all. In fact, they fell off a precipice during the global financial crisis and they stayed there. Markets like England, where demand is more than supply, South Africa, or even Australia, the market's recovered and they're back to where they were in terms of full value. So it's such an important fundamental that you need to find. And then lastly, the comparison with South Africa. Our economy is in a growth phase, but there's structural problems politically, particularly politically. Our debt is 11% of our GDP. Our growth in 2011 is 3.5. Our average property growth for the last 30 years has been 12%. The property market in 2009 actually lost 0.32%, so pretty much lost a little bit, but pretty much went stable. In 2010, the property market grew 6.75. I said the risk in South Africa is average, and I said the opportunity was great because you live here, you understand the market, and there's a lot of repossessed properties coming into the market. You need to know what you're doing, but I do think the opportunities are great if you understand them. But I want you to take it in view of the long-term contextual implications of your investment. Now let's move now quickly onto looking at the impact of what Clem Sunter said with regards to the scenarios for South Africa, because I think this is very, very important in terms of where we actually are. So he said there's 3 scenarios for South Africa. He said the first one is the Premier League. Now the top 50 countries in the world literally are organized by a Swiss company. They come up with the top 50 countries every year, and it's based on everything from your infrastructure to your education to your politics to your economy, everything. Now they basically say to be in the Premier League is to be one of the top countries in the world, to continue with the right type of rating, to get foreign direct investment, etc., etc. In 2008, we actually dropped to number 53 in that ranking, and that was because of our infrastructure problems and because of Eskom. In 2010, we recovered and we went back to 44, and this was because our banks handled the global financial crisis so well and didn't need to be bailed out. In 2011, unfortunately, we've fallen back to 52, and this is because of the policy uncertainty. This is because of Malema jumping up and saying we should nationalize the mines, we should nationalize land, etc., etc. We're currently the 32nd largest economy in the world. So that's really the Premier League in terms of where we are. And the most important thing is that we want to stay in that Premier League. The second scenario is where they call it there's no ducks in a row, and that's where we fall into the second division. That's where we literally become poor but peaceful. It will be disastrous for the government because there'll be no tax and there'll be no money. There'll be a huge amount of immigration offshore from the tax-paying community, from the educated people, and also a lot of companies will move offshore and take their money out of the country. And interesting enough, Nigeria, if this takes place, Nigeria will overtake South Africa by 2022. They're currently growing at about 8% a year, and admittedly it's off a low base, but South Africa is only currently growing at 3%. Now, if you're aware, we're part of the BRICS, but what Clem Sunter said is, well, what will happen by 2022 is that they might have to kick South Africa out and make Nigeria part of the BRICS. And then the last scenario was a failed state. And this is where violence literally goes up. It becomes ungovernable, unmanageable. Countries like Afghanistan, Libya, it becomes so unpredictable for the people that they turn their back on their country. So that's both people living in the country and foreign direct investors. So what are the flags for South Africa? What do we need to focus on? Well, the most important 4 flags that he brings up. The first one is nationalization. Now, he went on to say that it has been done successfully in Botswana, Namibia, and Chile, but he said that what happened there was that it was a resource that was found and immediately was put into a government organization. He said to take from private people and then nationalize it will literally destroy this country. It will destroy the perception of this country. It will destroy the foreign direct investment. And so we need to watch that very carefully. Now, interestingly enough, on that day, Justice Malala, who's a political correspondent, was actually speaking, and he said that Malema, there's no ways that Malema will be able to get this nationalization through. And he actually went on to say that even the National Union of Mine Workers is against the nationalization because they understand the impact that it will have on their jobs, etc., etc. But that is one that's very, very important that we need to watch with regards to nationalization. And I think a lot of that is going to come down to the race in terms of who actually heads up the ANC, who's going to be driving the ANC. And Moletsi Mbeki actually says that by 2020, the problem is in South Africa, there's going to be too many people on social grants, there's going to be no more taxes from mining, and this is when the whole ANC influence is going to wane. And by 2024, Moletsi Mbeki actually sees the ANC losing influence. So it's not something that's going to go away quickly, but I think we need to watch that. That is one of the major flags. The second major flag is clumsy implementation of the health policy. He basically said that if this doesn't work, the doctors will leave, and if the national health goes down and people can't literally have good doctors, good dentists, good health, then the high net worth and the educated people will leave the country. And again, that will have a massive impact on the tax status and the general well-being of the country as a whole. The third one was the media tribunal and basically taking the punitive powers that literally will stop the media from having freedom of speech, etc., etc. He said the problem with what's happening in the UK at the moment with the people of the world is certainly giving the governments. But interestingly enough, even in the last week or two, there seems to be changes with regards to that and a downgrading of the powers that act will have and keeping the freedom of speech. But again, that's a flag that you need to watch. And then lastly, the land grabs. He went on to say that if we have land grabs, it'll literally lead to a civil war. He said the last civil war we had in this country was in the late 1890s when the British tried to take on the Boers, and the Boers were literally fighting over their land and were determined to beat the British Empire. They were the only country to beat the British Empire and hold them off for over 2 years, and that was over the land. And he said they will not give up their land easily, but that the land has to be sorted. And he gave a solution as to how it was going to be. But I think something else that's very, very important here for us South Africans is that you need to understand the Agricultural Act, the Land Act, and what Malema is saying about how he wants to change the constitution so that he can give the land without compensation to people. Now, is it sensationalism? It doesn't matter. It's a flag. We need to watch it. We need to understand it. We need to understand the rights of property because that will be fundamental to the future in South Africa. The flags for the second division, the first one was the inclusive leadership. So a country like Singapore went very far ahead because they had inclusive leadership. And he gave Jacob Zuma a tick here, although interestingly enough, when Justice Malala stood up, he said that Zuma doesn't have the political clout, he doesn't have the inclusive leadership, and that is why there's going to be a race for the ANC next year. The next one was pockets of excellence. So he said that we need to use this to continue to raise excellence. Somewhere like SARS, the South African Revenue Service, has done such a good job in collecting the revenue for South Africa, and they're saying they need to use that and send that out across the rest of people in the rest of the state institutions and show them what's possible. And then also with regards to the schools, he mentioned that in South Africa we've got 5,000 excellent schools, and that's out of a total of 28,000 schools. He said we need to focus on making those 23,000 other schools that are pretty much dysfunctional, raise them to the standard of the 5,000 top schools. He said literally a death knell for our country would be if we drop the standard of those 5,000 schools to the 23,000 other ones. And then lastly, the balanced economy. He said that every economy that has grown by more than 7% has had an outward view of looking for 10 years more or longer. He said we're very competitive in South Africa with resources, with tourism, and the fact that we're a gateway to Africa. The IMF says that the top 7 countries in the world for growth are going to come out of Africa, and that we are the most advanced economy, and I've already mentioned Walmart and how they want to come in through South Africa to get into Africa. He said the most important thing with an inward economy is that we need entrepreneurship, we need to create jobs through small business, and China literally grew 98 places to number 2 in 32 years by having an open door policy. He says in America the entrepreneur is number 1. Recently Mark Zuckerberg met with Obama, and all the press was talking about was Mark Zuckerberg rather than Obama. And what do you think would happen here if someone was meeting with Zuma? And he went on to say by 2020 We should rather be saying we want to create 1 million more businesses rather than 5 million more employees or more jobs. So I think the interesting thing here is that where is the future? When I listened to him speak in November, it was 60% positive with only 30% negative. But we've now dropped 8 places and we're out of that top 50. So we're actually at the tipping point between positive and negative. He says the only way that we're going to be able to do it is like we organized a CADESA 1 and 2 in the early 90s to resolve how the economy was going to go forward, the constitution, etc., etc. He said we have to have a CADESA 3 to discuss the land problems because they're not going to go away. We need to have a big bang. We need to have a plan with targets. They need to be measured so that not only do the locals but the world community understand what it is we're going to do. We showed in the early 1990s when we were on the brink of civil war what was possible, and we're literally getting back to that brink now, and we need to come up with solutions. And I think the last thing is that he said also in South Africa we need to learn to celebrate excellence. There was a young African lad who was from the Transkei, Sibuselo Sisa, and this guy actually won the Anglo-American Award to go to UCT. He then got a bursary to go to Harvard. He's designed the first and most unique rocket fuel. He sent the highest rocket here in South Africa into space. And the interesting thing is that he literally is one of our greatest champions, and yet none of us have ever heard of him. He's had a planet named after him by a star named after him by NASA, and he's literally one of the most advanced. He's been celebrated. He's met with Obama and everyone in America, and yet we in South Africa have not been celebrating him. And I think that was what he was trying to say in terms of we need to find and celebrate the excellence so that the 15 million people on handouts are not trying to be supported by 5 million taxpayers. We need to give them a route. We need to give them a plan. We need to give them self-esteem so that they can achieve what they want. And lastly, he just went on to say here that it would be a lot better to be living in South Africa than the UK at the moment. So let's go back quickly to that probability calculator. And I am conscious of the time and I want to come to the end here. But I just wanted to show you on my probability calculator. There you can see the ducks in a row. So you can see the Premier League at 50%, you can see the ducks in a row at 40%, and you can see the failed state at 10%. Now, just interestingly enough, let's run another quick poll. Do you agree with these South African scenarios? Okay, I can see 68% of you have voted. The rest of you, if you can bring in your votes quickly so that I can move on and show you. I can see the votes are coming in. I'm going to give it another 5 seconds or so. Okay, let's close that poll, and I'll share it quickly with you. So you can see there that the yeses say 53%. 25% say no. I'd be interested as to what your thoughts are as to why no. And 22% say they don't know. So that's just interesting. I'll close it off so you can see my spreadsheet again. Okay. Now, let's look at some of these scenarios. Because what I wanted to do is I wanted to say, okay, well, if we stay in the Premier League, then I did these scenarios based on us staying in the Premier League originally. So this was where South Africa was tied first with Australia, America was third, and the UK was fourth. Now, Clem Sunter told me something a year or so ago, and he said, when people say, how much should you invest offshore? Well, he said something that's very clever. He said, what is your gut feel on the future of South Africa? So me personally, based on where we are at the moment, I'm about 70 to 80% positive about the future of the country. Based on that, I've got 70% of my investment in South Africa, and I've got 30% of my investment offshore. I'm very passionate about South Africa. I really believe in this country. I believe it's got high growth opportunities. I do believe it's a lot easier to make 15 Rand than it is to make £1. But I do take some of that money and I invest it offshore so that I can, in first world assets and first world income, so that I can have wealth preservation, a plan B, and that peace of mind, basically. But that's scenario one. Let's look at scenario two. So that's where we don't have our ducks in a row. And in this scenario, that's where Australia came out as number one, South Africa came out as number two, America came out as number three, and the UK came out as number 4. And interesting enough here, the investment got split 50-50. So 50-50 between local and 50-50, well, sorry, and 50 with offshore. And then finally, if you were to go to a failed state, taking into account both the South African scenarios and the offshore scenarios, you would see now that Australia was number 1, the US was number 2, the UK was number 3, and South Africa was number 4. And in this circumstance, you would probably want to move all your money offshore, although I certainly know a lot of friends that made a lot of money in Zim. So my logic was I'd probably keep sort of 20% in South Africa with 80% of it offshore. But I suppose a lot of that would depend on me actually immigrating, because based on our clients and people that do immigrate, it would be, you know, literally 100% of my money offshore. But it just gives you an idea of the 3 different scenarios. And just to give you quickly a summary of them, if you look here in terms of where do you invest between local and offshore and the scenario, the probability and the ranking, you can see in the Premier League, there's a 50% probability. We rank tie first as to where we should invest with Australia, and that's where we invest 70% locally and 30% offshore. If we don't get our ducks in a row, which is a 40% probability, that's where we rank second. We invest 50% locally and 50% offshore. And then lastly, the failed state, which has a 10% probability, it ranks us as number 4th place to invest, and that's where literally you invest 20% of your money locally and, or if not all of your money, offshore. So that just gives you a little bit of breakdown in terms of where they actually are. Okay, let me just finish off, and then I will come back to the questions, because I can see there's quite a few questions there. Just I wanted to just put this slide up. Again, it's my gut feel, but the difference between local and offshore property, in terms of the returns, locally they're higher than offshore, although one needs to take into account the devaluation of the rand, because that often balances it. Property is a lot easier locally than it is offshore. You've got you don't necessarily have peace of mind in South Africa. Legislation like the rates, not being able to get rid of tenants, etc., versus offshore that's a lot more legislated and a lot more in the favor of the investor. Financial planning locally, maybe, whereas offshore, yes. A rand hedge, no, locally, whereas offshore, yes. And diversification, no, whereas offshore, yes. So it just gives a balance in terms of what you want, and that's why I believe you've got to balance your investment strategy between them. So in conclusion, and I got asked this question, the very first question of the night was, there's actually a stat that 49% of the world's wealth is held in property. Kaylee Smith actually said, where's the rest of the world's wealth held? It's in different asset classes, Kaylee. So it's in the stock market, it's in gold, it's in all the other types of asset classes that there are, bonds, etc. But 49% of the world's wealth is actually held in property. And then lastly, a saying which I love from Jim Rohn, he says, to become financially independent, you must turn part of your income into capital, turn capital into enterprise, turn enterprise into profit, turn profit into investment, and turn investment into financial independence. And I think the purpose of tonight is the essence of that quote, because I wanted to give you the knowledge that I'd learned from a great person like Clem Sunter. I wanted to give you the different scenarios. I wanted to give you the different research, because that then can help you with regards to how you invest your income, how you get capital, how you literally build up your investments, because that will ultimately lead to your financial freedom. There's one last thing that I want to say, and that a lot of people try and do this all on their own. I'm a big believer, and the whole purpose of Let's Talk Property is that it's all about going out there and learning from the best, learning what they're doing and implementing their strategies. There's a law of nature that literally one bird flying in a flock versus 25 birds flying in a flock. 25 birds flying in a flock can fly 70% further. And you know, it's the same. It doesn't matter if you look at birds or animals. And so our strategy is to be able to work together, with the best, find the best of breed partners, understand the market, understand the fundamentals, so that you can make the right investment decisions. And really tonight, that has been our purpose and our goal and our objective. So you can see there's all our contact details that's come up, our website, ipsinvest.com, my email, scott@ipsinvest.com, our telephone number, our blog, Twitter, all this research I put up on our blog. Twitter, I let you know. I don't tell you what I'm having for breakfast. I let you know when I get the latest research. You've got YouTube, although I'm having problems with my YouTube account at the moment, but there it is with all the videos, and then our Facebook page. So I want to run through here. There's quite a few questions that have come up, and I just want to run through them quickly and answer each and every one of them so that I can try and add as much value as possible. And if you've got any more questions, please send them through to you. So Anita, please hang around. I want to answer some of your questions. So, right. Okay, so let me just see here. Just to repeat, guys, I will send you that audio clip because I can see that quite a few people have been asking for it. Okay, I'll send you the whole talk. David, you can just send me an email and let me know. The spreadsheets should have come up. Okay, Anita, we spoke about the National Demographic Revolution. Okay, Simon Deploy says South Africa has a water shortage and farmers are being chased off the land. That's what I spoke about as one of the flags that you need to look at, Simon, in terms of where we are. And that's why with the scenario planning, there's a number of moving parts, and we've obviously got to try and take them all into account. Okay, Anita said, the high American work ethic, the cowboy is alive and well, very third world, low knowledge and work ethic. Would that not be a driver? Anita, I think it certainly is, and it's certainly something that's very important. One of the things that I find fascinating is that by 2014, 70% of the African continent will have access to mobile, and with access to mobile will come education, and there's definitely a thirst for knowledge. And at the end of the day, it will be the same as what happened in the East, because these people will be prepared to work at very low rates, which will make it very productive, which is why, you know, India and Asia became so successful. Kaylee said, what about high returns being seen in gold and silver over the past 3 years? Kaylee, I completely agree with you in terms of those high returns, and that's what I tried to show you, that during recessions and during times of massive uncertainty, that's where people like to put their money. My only downside with that is that there's no income that you can earn from them. Bob Max says, where you've been living before the past 3 years? Bob, I was in London for 9 years, from 1999 to 2007. Was it too cold for you in the UK? Yes, it was, Bob. One of the reasons I left the UK was because of the weather. I moved to Johannesburg for 3.5 years. I had a fantastic 3.5 years there now, and I now live on the beach in Cape Town, which is absolutely amazing, and I really am living my dream. And I believe with technology and the beauties nowadays is that you can live wherever you want and live the lifestyle that you want. And just a recommendation, nothing to do with property, but read a book called The 4-Hour Workweek by Tim Ferriss. Andrew Elwood said, Scott, very interesting, and I'm enjoying this webinar big time. I'm really bummed as I have to leave my PC now. Is there any way you could send me the link recorded? I would super appreciate. Don't worry, Andrew, I will be emailing everyone. Kristen said, Eek, please remind me to ask about the slide, second verse. Okay, so Kristen was just asking about the stats and what was happening. I think one thing that's also very important, when you look at statistics and you see different markets, sometimes in terms of growth and all property going down, you've got to remember that it's based on segments and what's happening and the different areas that you're focusing on. And that for me is so critical. You know, I could show you stuff in Sydney saying that the property market has dropped, and that could just be the top end of the market. So it's very, very specific. And also if you're investing in property, you've got to look at long-term and what's happening with the economy, what's happening with the population growth, what's happening with the infrastructure growth, because all those fundamentals will have a huge impact on the financial investment. Al-Marie said, if one can find a reputable job in South Africa with a good income, one can live here. Most people left SA to the UK. Completely agree, Al-Marie. I left and lived in London for 9 years thinking that I needed to live in London to make my fortune. I then moved back to South Africa in 2007. It was the best thing I ever did. It's a lot easier to make 15 Rand than it is to make £1. And I don't think it's all, you know, my wife came back and got a job and was earning more money in South Africa than she was earning in London. But I don't think it's about necessarily finding a job. Find your entrepreneurial spirit. There's so much opportunity here. So many of my friends have gone out and created their own opportunities, and it just makes for such an exciting life to be living your destiny. Anita said, we are 80% out and 20% in, depend how much you have is not. Okay, so that's with regards to, so again, Anita, that's your viewpoint on how positive you are with South Africa, and I completely agree. I've got some clients in Pretoria that are 100% out. They literally live in South Africa and their wealth lives overseas. That's your choice. I was just trying to give you some guidelines as to what is possible. Anita said, how did they make money in Zim? There were huge amounts of opportunities in Zim. One of my mates owns a Debonair's Pizza and was earning $20,000 a month with a pizza store. Lizette Hibbert said, I voted no because I am very concerned about the impact of AIDS and poor education on the future of South Africa. Lizette, completely agree with you. Clem Sunter actually brought up something which was incredibly scary, that something like only 13% of kids at age 9 could read or do maths in South Africa, and that we ranked number 163 in the world in maths and science. And that for me is a huge, huge problem if we want to have a good economy going forward. And one of the reasons why I support a charity called Tree, because I believe that educating, particularly preschool children, is literally going to determine the future of our country. Anita said, failed state is now over 50%. I spent a lot of time in peri-urban and rural. There are angry guys out there. A man with no plan is a dangerous man. We have too many with no plans. Completely agree with you, Anita. It's one of my biggest concerns. And like I always say to people, at the end of the day, you know, it's one man, one vote. And unfortunately, Malema can get the populist people. So, again, you've got to watch the flags. I'm not saying where the future of the country is going. I'm just trying to show you the tools and tricks that I've learned off Clem Sunter so that you can make educated decisions with regards to where you are. Brian Walther said, Scott, apologies, I have to run, but your presentation has been very informative. Please would you be kind enough to send through the pertinent research? I'll certainly do that, Ryan. Bob, you live in Cape Town, but telephone number Joburg. Bob, the office number is Johannesburg. It's all about virtual offices. Again, 4-hour work week, Bob. You can have anything you want. We've got offices in Cape Town and in Johannesburg and in Durban. So, yeah, it's just where the main head office number is. Anita says, good point. Bob Max said, repeat 4. Okay, the book is The 4-Hour Work Week by Tim Ferriss. So, The 4-Hour Work Week by Tim Ferriss. Brilliant, brilliant book. It's changed the way, literally changed my life, and it's changed so many of my friends' lives who have decided to go and live where they want, because we all spend our lives working and then dreaming about retirement or dreaming about going on holiday. Why not just go and live on holiday? I literally live in a house on the beach. I've never in my life been to a house that has as good a view when I've ever been on holiday. And I now live there. I literally walk onto the beach. I look at the sea all day long, and I'm as productive as I've ever been. So it's just a bit of a tip. Nothing to do with property or Clem Sunter. Brian Matthews said, hi, Scott. Could you send me the whole talk? Thanks, Brian. Frank said, also didn't hear the video. Could you send by email? Bob Max said, have you been to Australia? Bob, I go to Australia once every 3 months. Anywhere that we help people invest, we spend a huge amount of money and time researching those markets on a consistent basis so that we're constantly getting a feel. And if you're interested in what's happening in Oz, I did a 35-page market report on when I was there 2 months ago on the Australian market and what is happening. And to answer your question, yes, it's Tim Ferriss, Ferris. Guys, I am conscious of the time. We're nearly on the hour-and-a-half mark. Is there anything else that anyone else would like me to help, basically? Dave Martin says, solid, Scott. I'm in Africa to stay after 12 years abroad in Oz, US, and UK. Let's grab a beer sometime. I'd love to, Dave. Please, you've got my email there. Please give me an email and let's sort it out. Daniel says, excellent webinar. Thank you very much, Daniel. Guys, I am going to send you an email to follow up with. I would really appreciate it if you could give me your feedback. And let's just run a little poll here. Where do you think the best place is to invest? I've given you the different scenarios. I've tried to give you my viewpoints. I've tried to be scientific based on what Clem Sunter said. Let's. I know a number of people have had to run because I've run over time here, but I'm just interested. What does everyone think in terms of where we should be investing? Not that it'll make any difference, but it'll just be interesting to see. So we've got 62% of people have voted here. I'll just give you a little bit more time. Henry Eustace says, thanks very much, Henry. Thanks to all of you for being online. It's an absolute honor and a privilege. I love sharing this type of information. If you've got any comments, both positive or negative, please reply to me and let me know. If they're negative, that's fantastic because I can get better. If they're positive, I'm human and I like to get positive feedback. Okay, I can see here I think we've pretty much closed it. So let's just look here. Very interesting. 38% of people think that South Africa is the #1 place to invest. 51% of people think Australia is the number one place to invest. The US, 5%, and the UK, 5%. So very interesting from a complete broad-based. I have to say that if I take a view to 2050, and the fact that I lived in London, the quality of people moving to Australia from all over the world is just getting stronger and stronger. They're so strict with their population. Their economies run well, they are resources-based, and they're close to China. And for me, I read a book by Robert Kiyosaki called Conspiracy of the Rich, and I would highly recommend that you go and read that book. And he basically said the best way to get wealthy is to follow long-term trends. And having lived in London, I honestly believe at some level that Australia fundamentally is going to be a lot sounder over the next 30 years than say a London or an England would. I've lived there for 9 years, and I believe there are issues. I'm not saying it's not a good place to invest. I'm just saying if you were to take a long-term view. And I really think this debt issue in both America and England and in Europe is really going to play out. So just something to take into account, which I think is interesting, basically. Frank has said, Bob Max has said, thanks, very interesting. Frank D'Souza said, reason being the prices have dropped so much and the exchange is right. So yeah, 100%, Frank, I presume you're talking about investing offshore, but there's a strong rand at the moment, and it does give people the opportunity about America. So yeah, I think don't get me wrong, Frank, but be very careful where you invest in America, because I've spent a lot of time there, and there's a lot of big lemons out there, basically. Peter Runger says, depends how you invest. Below market value in the UK is still good. Completely agree with you, Peter. I'm not saying that either one is better or worse than the other. I've always liked England, particularly London, because it's been very good to me, and there's always been strong tenant demand, and I think there will be, particularly in London, for the foreseeable future. So I'm not saying that that's not something. For me, it's not about one or the other. It's about I've got investments in both. So for me, it's about, but I'm just trying to give you my viewpoint on long-term trends. Rena Mayer said, Australia is very expensive to get into investment, not easy if you do not have lots to spend. Are there easier ways for smaller investors? Thanks, very interesting. Rena, the biggest challenge we've got for investing offshore is that the banks, whether it's England or Australia, in fact, in England at the moment, you're generally getting between a 50 to 60% loan to value. In Australia, it tends to be between 60 to 70. So the challenge is that you've got to come up with a hefty deposit plus costs to be able to invest. There are smaller funds that you can invest in, but they are, arguably slightly more risky. But yeah, let me know if you are interested. I am speaking to some people about finding other ways so that people with smaller amounts of money can take advantage of those opportunities. And Almarie says, I'm purely saying to invest in SA because I love my country and would love to come back and have a coffee on the beach. Currently working in Qatar. A lot of info and numbers tonight. Trust I'll be able to implement some of the info I've received with the webinars very soon. Thank you, Scott. Almarie, I'll be emailing everyone a copy of the webinar and the research, etc. I understand it's a lot of numbers, but I wanted to try and give you as much of an overview as I possibly could. And Bob Max said, what's the name of that book? It's called Conspiracy of the Rich. Bob, I'm helping you with your library tonight. But please fire. If anyone else has got any other questions, ask me. I'm more than happy to share. So, Descender Naidu has said, thank you, Scott. Nice talk. It's an absolute pleasure. And Cecil said, thank you, Scott. It was very interesting. Okay, guys, so I think we're getting to the end of the session here. If there's any other questions that anyone else would like to fire through, let me know, and I will, be very happy to answer. But if they don't come through in the very near future, then I'm going to call it tonight, and, we can take it from there. I'm going to finish off with one last little survey. Let's have a bit of fun, see if everyone's still awake. What's the best investment in your opinion? Taking everything I've given you in terms of the scenarios, the different countries, the debts, the positives, the negatives, where do you think you should be investing? What do you think the opportunities are? Obviously, I know that this is a bit of a skewed thing when you're on a webinar called Let's Talk Property, but I'm just interested as to what different people's opinions are in terms of where they should be investing. Okay, I can see that 76% of people have voted. The last couple of people are coming through. Okay, so let's close off this, and let's just share with you very interesting actually overwhelmingly properties. 81% of people thought that they should be investing in property. 11% in the stock market, 3% in the bank, and 6% in gold. And on that note, ladies and gentlemen, I'm going to sign off for the evening. It's been great. Watch out for this space for Let's Talk Property. My aim is that I will be interviewing some of the most successful entrepreneurs and property investors both in South Africa and worldwide on an ongoing basis, and at least monthly, if not bi-monthly. I want to be bringing you stuff of real value. So if there's things that you're interested in, if there's topics that you're interested in, if there's people that you would like to hear from, then let me know about it, because I want to go out there. I want to find that information. I want to help you so that you can make more educated decisions. If there's no further questions, I want to thank you for your time. It's been a real honor, an absolute pleasure to present to so many people. Thank you so much for the energy and all the questions, both the positive and the negative. We've all allowed our opinion. It's awesome. Have a fantastic evening. And as I always say, if you're living in South Africa or you're from South Africa, be proud. We live in a fantastic country. Thank you and good night.